If you watch only the Federal Reserve, then you may be watching the wrong number. Gold and silver can move before the Fed speaks. They can move after the Fed speaks. They can even move against what the Fed says. The number that often tells the deeper story is hiding inside the bond market. It is the real yield on US Treasury bonds. When that number rises, gold and silver can face pressure. When it falls, the door can open for a powerful precious metals rally. And right now, the bond market is sending a message that deserves your attention. Gold has recently pushed back above $4,500, while silver has also recovered as Treasury yields moved lower. The move came after the US Treasury announced that it would at least double the size of its longer-dated bond buybacks. That decision helped push yields lower and weakened the US dollar. So what is the real number you should watch? It is not simply the Fed funds rate. It is not simply the CPI number. It is not even the US dollar index. The number I want you to remember is the real yield, more specifically the inflation-adjusted yield on longer-dated US government debt. This number tells us what investors are really earning after inflation is taken into account. That matters because gold does not pay interest. Silver does not pay interest either. When investors can earn a strong inflation-adjusted return from government bonds, the opportunity cost of holding metals becomes higher. When that real return falls, gold and silver can become much more attractive. Think about it in simple terms. Imagine you have two choices. One asset gives you interest. The other asset gives you no interest, but can protect purchasing power and respond to financial uncertainty. If the interest-bearing asset becomes more attractive, then money can move away from metals. If the real return on that asset falls, then the opportunity cost of holding metals becomes smaller. That is one reason real yields can have such a powerful relationship with gold and silver. This is why the market can sometimes ignore a Fed statement. Traders may hear a hawkish message from the central bank. But if bond yields fall anyway, then gold can still rise. The opposite can also happen. The Fed can sound supportive of lower rates. Yet if long-term yields surge, then gold and silver can struggle. That distinction is becoming extremely important right now. The latest market action gives us a perfect example. On August 19th, the US Treasury announced that it would increase the size of its longer-dated Treasury buyback operations. The maximum size of individual operations was set to rise from $2 billion to at least $4 billion. The move helped stabilize the longer end of the bond market. Treasury yields fell sharply. The dollar also weakened. Gold then jumped above $4,500 while silver gained strongly as well. That is not a random relationship. The bond market moved, the dollar moved, gold moved, silver moved. And the connection between those markets is the real yield. Now let us take this one step deeper because this is where many investors get confused. You will often hear people say that higher interest rates are bad for gold. That statement is too simple. The market does not care only about the interest rate printed on a treasury bond. It cares about the return after inflation expectations are considered. Suppose a 10-year treasury yield is 5%. That sounds attractive. But imagine inflation expectations are 3%. The approximate real yield is then around 2%. Now imagine the treasury yield remains near 5% while inflation expectations rise to 4%. The real yield falls toward 1%. The nominal yield did not fall, but the real yield did, and gold can respond to that difference. This is why inflation matters so much. It is also why the Federal Reserve matters. It is why Treasury yields matter, and it is why the US dollar matters. All of these forces connect through the same financial system. When inflation expectations rise faster than nominal yields, the real return on bonds can fall. That can make gold more attractive. When inflation expectations fall while nominal yields remain high, the real return can rise. That can create pressure on gold and silver. This is one reason precious metals traders spend so much time watching treasury markets. The relationship is not perfect. Markets are never that simple. Gold can rise even when real yields rise if investors are worried about financial instability or geopolitical risk. Central bank demand can also support gold even when traditional rate signals look negative. ETF flows can change the picture. Currency movements can change the picture. Physical demand can change the picture. But over long periods, the real yield remains one of the most important signals for precious metals. And silver can be even more interesting. Gold is primarily viewed as monetary metal and a store of value. Silver has that role too. But silver also has major industrial demand. That means silver can respond to economic growth expectations at the same time that it responds to monetary conditions. When real yields fall, silver can benefit from easier financial conditions. When the dollar falls, silver can benefit from a more favorable currency environment. When industrial demand improves, silver can receive another source of support. That combination can create explosive moves. We have already seen how violent silver can become. Earlier this year, silver reached extremely high levels before suffering a major correction. Recent market reports showed silver falling sharply during periods of rising real yields. Another report noted that a record high real yield on 10-year bonds had pressured silver before cooler inflation and lower rate expectations helped trigger an 11% rebound over 10 days. That tells you something important. Silver does not need the Fed to officially cut rates before the market can begin pricing easier conditions. The bond market can do it first, currency traders can do it first, inflation expectations can do it first, and precious metals can react before the headline arrives. This is why the title of this video is so important. The one number most people ignore is not always the number that makes the headlines. The Fed funds rate gets headlines, CPI gets headlines, jobs data gets headlines, the dollar gets headlines. But the real yield quietly combines several of those forces into one market signal, and that makes it incredibly useful. Now look at what is happening today. Gold has been trading around the $4,500 area after reaching a more than 2-month high near $4,526 before pulling back. Reuters reported that the recent rally was driven in part by the Treasury announcement and the resulting decline in yields and the dollar. Another market report showed gold trading near $4,490 after breaking above $4,500. Silver was also reclaiming important levels as bond yields declined. At the same time, the Federal Reserve is not giving investors a simple bullish message. The latest Fed minutes showed that policymakers remain concerned about inflation. Some officials were open to future rate hikes. That is a hawkish signal. Yet the market is not automatically selling gold because traders are also looking at softer inflation and labor market conditions. This is where the real yield becomes extremely useful. Imagine the Fed sounds hawkish. That sounds bearish for gold, but then long-term Treasury yields fall. The dollar weakens, real yields fall. Gold rises. That is not a contradiction. It simply means the bond market is telling you that the long-term financial conditions are different from the short-term policy message. The market is always looking beyond the next meeting. That is the key. Investors are not buying or selling gold only because of what the Fed says today. They are positioning for what they believe inflation rates, growth, debt supply, and monetary policy will look like months and years from now. That is why the long end of the Treasury curve matters so much. It reflects a huge amount of information about future expectations. And there is another major factor that makes this story even more interesting. The US government has enormous financing needs. The Treasury has to issue debt. Investors have to absorb that debt. When investors demand higher yields, the government has to pay more to borrow. That can create pressure throughout financial markets. It can also change the relationship between bonds and precious metals. If long-term yields rise because investors demand more compensation for inflation or fiscal risk, then the nominal yield may rise. But what happens to real yields depends on what inflation expectations are doing at the same time. This distinction is critical. If nominal yields rise because inflation expectations are rising faster, then gold may not react the way a simple textbook would suggest. Gold can actually benefit from the fear that inflation is becoming harder to control. That is why you should never look at one market signal in isolation. You want to know why the yield is moving. Is it rising because growth is strong? Is it rising because inflation expectations are rising? Is it rising because investors are demanding more compensation for fiscal risk? Or is it rising because the Fed is expected to stay restrictive? Those are very different situations. The same number can have different meanings depending on the reason behind the move, and that is exactly why the real yield deserves your attention. Now let us bring the US dollar into the picture. Gold is priced globally in dollars. When the dollar becomes stronger, gold can become more expensive for buyers using other currencies. That can reduce demand at the margin. When the dollar weakens, gold can become relatively cheaper for international buyers. That can support demand. The dollar also reflects global confidence in U.S. assets. If investors are comfortable holding dollars and treasuries, then precious metals can face competition. If confidence in those assets weakens, then gold can become more attractive. The recent market action again gives us a clear example. When Treasury yields dropped after the buyback announcement, the dollar also declined. Gold moved higher at the same time. Reuters reported that gold was supported by both lower yields and a weaker dollar. This is why I would not tell you to watch gold alone. Watch the bond market. Watch the real yield. Watch the dollar. Then watch gold, and then watch silver. That sequence can help you understand what is driving the move. There is another reason this matters for silver investors. Silver is often more volatile than gold. When monetary conditions improve, silver can move much faster. When monetary conditions tighten, silver can fall much faster. That is because silver has both investment demand and industrial demand. So if real yields fall while economic expectations remain healthy, silver can receive support from both sides. But if real yields rise because investors fear aggressive tightening and economic growth slows, then silver can face pressure from both sides. That makes the real yield a useful early warning signal. If you see real yields breaking sharply higher, you should understand that the environment may be becoming more difficult for precious metals. If you see real yields breaking lower, while the dollar also weakens, then the setup can become much more supportive. This does not guarantee a rally. Nothing guarantees a rally, but it changes the odds. And that is what professional market analysis is about. It is not about predicting every single candle. It is about understanding the forces that can shift probabilities. Now think about what could happen next. One scenario is that real yields continue to decline. If that happens, gold could remain supported above major psychological levels. Silver could also benefit as investors look for higher beta exposure to the precious metals trend. A weaker dollar would strengthen that setup. Lower Treasury yields would strengthen it further. And if economic data begins to show a softer labor market, then expectations for easier Fed policy could become another catalyst. That combination could create a powerful environment for metals. But there is another scenario. Real yields could reverse higher. The dollar could strengthen. The Fed could continue warning about inflation. Long-term Treasury yields could rise again. If that happens, gold could lose momentum. Silver could experience a much larger reaction. This is why the real yield is not simply a bullish indicator, it is also a risk indicator. It tells you when the financial environment is becoming more hostile to non-yielding assets. Now there is one more piece that investors cannot ignore: central bank buying. Central banks have become an important source of structural demand for gold. That demand can reduce the sensitivity of gold to short-term rate movements. If central banks continue building gold reserves, then dips can find stronger buyers. Silver does not receive the same level of central bank demand. That is another reason silver can behave differently from gold. Gold can have a structural monetary bid. Silver depends more heavily on industrial demand and investment flows. This difference becomes important when the market enters a major trend. If gold stays strong because central banks continue accumulating while real yields decline, then silver may eventually receive a powerful catch-up trade. That is one reason the gold to silver ratio is worth watching. When gold rises faster than silver, the ratio increases. When silver begins outperforming gold, the ratio falls. A falling ratio can signal that silver is gaining strength relative to gold. But again, the ratio should not be used alone. You need to understand why it is moving. The same is true with real yields. Do not simply see a number and buy or sell. Understand the story behind the number. This is the difference between reacting to headlines and reading the market. Right now, the market is sending mixed signals. The Fed minutes are not completely friendly to precious metals. Inflation remains a major concern. Long-term Treasury yields have recently reached very high levels, yet Treasury buybacks have pushed yields lower. The dollar has weakened. Gold has surged back above $4,500. Silver has also recovered. and investors are watching the next round of economic data for confirmation. That is exactly the kind of environment where the real yield becomes valuable. It helps you cut through the noise. Instead of asking only whether the Fed is hawkish or dovish, you can ask a better question. What is happening to the inflation-adjusted return investors can earn from Treasury bonds? If that return is falling, then the opportunity cost of owning gold is falling. If that return is rising, then the opportunity cost is rising. That is the core idea. And once you understand it, you start seeing precious metals differently. You stop treating every Fed headline as an isolated event. You begin watching the bond market. You begin watching inflation expectations. You begin watching the dollar. You begin watching the difference between nominal yields and real yields. And suddenly, many of the confusing moves in gold and silver start making more sense. There is also a major psychological effect here. Markets are forward-looking. Investors do not wait for inflation to become a disaster before thinking about inflation protection. They do not wait for the Fed to cut rates before positioning for lower rates. They do not wait for the dollar to collapse before thinking about currency diversification. They price expectations. That means gold and silver can move long before the economic data confirms the story. This is why the next major move could happen when almost nobody is talking about it. The headline may come later. The bond market may move first, the real yield may move first, the dollar may move first, and precious metals may follow. So if you own gold or silver or you are considering buying either metal, then there is one simple habit I would strongly encourage you to develop. Before you react to a dramatic Fed headline, check the real yield. Then check the direction of Treasury yields. Then check the dollar. Then look at gold. Then look at silver. That sequence gives you context. It does not guarantee the outcome, but it can help you avoid emotional decisions, because precious metals can be extremely volatile. Silver especially can move several percentage points in a short period. A strong trend can become an overshoot. A bullish breakout can fail. A bearish breakdown can reverse. That is why risk management matters. The goal is not to chase every move. The goal is to understand the environment, and right now the environment is changing quickly. The Treasury has announced larger, long-dated buybacks. Bond yields have reacted. The dollar has weakened. Gold has responded, silver has responded, and the Federal Reserve remains focused on inflation risks. That creates a fascinating battle between monetary policy and financial conditions. The Fed can talk tough, but the bond market can move in the opposite direction. The Treasury can influence liquidity. Inflation expectations can change, economic data can change rate expectations, and the real yield can shift. That is why one number can tell you more than a single headline. Not because the Fed is irrelevant, the Fed is extremely important, but because the real yield captures the economic pressure that investors actually face when choosing between bonds and precious metals. So remember this. Gold does not compete against the Fed. Gold competes against the opportunity cost of holding other assets, and the real yield is one of the clearest measures of that opportunity cost. Silver follows a similar logic, but with additional industrial forces. If real yields fall and economic activity remains resilient, then silver can become especially interesting. If real yields rise sharply and growth weakens, then silver can become vulnerable. That is the signal I want you watching. Not tomorrow's headline, not the loudest prediction on social media, not the most dramatic gold target. Watch the real yield, watch the direction, watch why it is moving. Then watch what gold and silver do in response. If gold rises while real yields fall, that is a confirmation. If silver begins outperforming gold at the same time, that is even more interesting. If the dollar weakens at the same time, the setup becomes stronger. But if real yields surge and the dollar rallies, then be careful. The metals may be telling you that the market is entering a different phase. And that is ultimately the message of this entire discussion. The most important number is often not the one making the biggest headline. The real yield can quietly shape the opportunity cost of holding gold. It can influence investment flows. It can affect the dollar. It can change expectations for precious metals. And it can help explain why gold and silver sometimes rise even when the Fed sounds hawkish. Today, gold is once again showing why this matters. The metal recently moved above $4,500 before giving back part of the rally. Silver has also been responding to the same changing yield and dollar environment. The next major move will depend on whether this decline in yields continues or reverses. If real yields continue falling, then the path could become much more supportive for precious metals. If real yields rise again, then gold and silver may face another test. That is the battle to watch. So the next time you see a headline saying the Fed shocked the market, do not immediately decide what it means for gold. Look deeper. Open the Treasury market. Find the real yield. Ask yourself whether it is rising or falling. Ask why it is moving. Then look at the dollar. Then look at gold. Then look at silver. That simple process can give you a much clearer picture of what is actually happening beneath the headlines. And if you found this analysis useful, then make sure you subscribe to Silver and Gold Watch. We track the forces behind gold and silver so you can understand the story instead of simply reacting to the noise. Hit the like button if you want more market breakdowns like this. And tell me in the comments what you think. Will real yields continue falling? Will gold push through the next major resistance zone? And can silver finally begin outperforming gold in a major way? Your opinion matters. Subscribe to Silver and Gold Watch and stay focused on the number that most investors ignore. Because sometimes the biggest clue in the gold and silver market is not found in the Fed statement. It is hiding in the bond market,